Hi traders, in this video I'm going to be talking about failed breakouts, how to anticipate failed breakouts, and how when you can't even anticipate them, how you can still be prepared for them. So here we have a chart of the S&P 500 mini contract, and this is today's price action. And there was a nice failed breakout we got at the end of the day, and I want to discuss how this could have been anticipated before the breakout. So first of all, leading up to failed breakouts, there's going to be certain market conditions that are going to be more conducive to a failed breakout. So if relative volume is running low, relative volume is just the average volume for X amount of days, whatever you're calculating. Relative volume was running like 80 to 90%. So that's saying it's about 20 to 10% below average. So that's one sign that a breakout might not stick. Another sign is when you get a neutral day type. So neutral day type is the day type we got today. It kind of just goes from the highs to the lows, a lot of chopping around, and we're building value in this high volume area. So I have two horizontal support and resistance lines laid out from the low to the high, and we were pretty much remained in those support and resistance lines for the majority of the day. It's going to be very difficult for the market to just move away from this high volume area. It's going to need force, and that's going to need a lot of volume to come in. So when you see that the market's coming later on into the day and it tries to push out up here, this is unlikely that we're going to get a breakout. First of all, we got a neutral day type. We're chopping around all day. Second of all, we're at the point in the breakout. Relative volume was 81% when we tried to break out. So we're at 19% below average volume. So that's a sign. Plus we got the neutral day type. I'm thinking this might not be a good point to short. Now when you're trading a neutral day type, you definitely want to buy the lows and sell the highs. And as we get more towards the end of the day, you might get like what we got here is a stop run. So all this was is a push out. Bigger traders can get liquidity and then they could slam it back down. So towards the end of the day, when you get a neutral day type, you definitely want to be aware that this kind of action can happen. So we see the market pushes up here, slams right back in, and that's when you want to go short. So for anyone who doesn't know, going short is just selling and profiting from the decline in price. So now when you break out, you come back in, that's a failed breakout. You want to get short, and where's the target on this trade? Right to the support level, which is the bottom of the neutral day type. So that's where we're going back and forth. You know, you want to avoid trading from the middle because that's where most of the chop is, and you want to make sure you're trading from the extremes. Now I want to show another example of a failed breakout on a little bit longer time frame. I took this trade myself, but it was a failure, and I actually got into it expecting it to break down, and then it failed. And I just want to show how I was able to switch quickly and be flexible, and that's going to help a lot of traders out. So let's go back here. If we see this chart, I scrolled out so it's really small. This is still the 5-minute time period. And if you can see where I have this bluish green horizontal rectangle down at the bottom, that's showing the balance area low. So this area is a balance area and we're going from low to high, low to high. And I'm actually going to bring out a daily chart to show it a little better. So you can see each one of these bars represents one day. I can zoom out in here, and right here you can see that we've been coming from low to high, low to high. Now, when you're trading on a smaller time frame, sometimes you can anticipate these breakouts a little bit earlier, and that's what I tried to do. I tried to get on the gun a little bit earlier and see if I could catch a larger move, and it just didn't play out, and I ended up getting stopped out. But seeing a stop out and how you can quickly get back from it's going to help a lot of new traders as well. So now we're back at the day we broke out. So if you look down here, I'm going to zoom in a little bit on the chart. And this is where we got the failed breakout. So the market opens up pretty weak. It's pushing down. It breaks the low. And this is where I entered short, right in here, expecting a nice breakdown. Now when you have a long intermediate term balance area like this is where trends start from. So I was anticipating a trend on this day. I didn't get it, and price snapped back into the previous day's range. So what you want to do with any time you're taking a breakout trade, you have to put yourself in the mind frame that this could break out, this could fail, and what am I going to do it breaks out or if it fails. In this situation, I got short, came back out, but as soon as I got short, I already had an order sitting there exactly where my stop was. So if I did get stopped out, it would switch me to a long and it would take me out from there. So I got stopped out on the short, entered the long, and I was in a great position. Now, where do you want to target for this? Now, when you're taking a day trade, you're going to target a couple supports up because usually you're going to just break through the first support if it's close. If you can also take this as a longer term trade as well, and the target actually is the upper end of balance. So if I bring back over the daily chart, we're going to be going from the low area balance to the high to the low to the high until we get a breakout. Now, when we break out of this balance area, it's going to be explosive because stop orders are likely going to be accumulating below the balance and above the balance area, and that breakout's really going to have some explosive force behind it. I've given you two ways you can anticipate false breakouts, one a little bit longer time frame when you're watching a balance area, and also how you can make sure that you're positioned both ways. If you get stopped out, you're ready to go the opposite way and you know that you got an excellent trade. Because if you get stopped out on a false breakout, the amazing thing is it's a failure. So the market's saying we don't want this price, it's not accepted, and it violently goes the other way and it tries to discover price once again. The first method I showed you was today's price action and how we had a neutral day type. Price is going to really struggle to break out of that, and we tried to break out. It was just a nice little stop run, trick a couple rookie traders, and then we snapped right back in. Beautiful trade back down to the low of the day. And that's all there is to it. So just be prepared when you're trading, when you're taking a breakout trade. Be prepared that you could have a failure. Now quite a few techniques to know when you take a breakout and when not to, but that's beyond the scope of this video. So I hope this video helped you guys out. If you want to learn more about this, you can go to my website at optictrading.com and check out the professional trading course. Bye guys.